So the market's recently been dropping, then bounced. Your portfolio's down, then back up. Your emotions are running high. The financial news is full of words like sell-off, correction, panic, and my personal favourite, carnage, which is a bit dramatic, let's be honest. And right now, YouTube is absolutely full of videos titled something like, "The crash is here, get your money out now," or "How to get rich while everyone else is panicking." And they all have thumbnails of men in suits looking either very alarmed or very smug. Well, YouTube's maybe not full of those titles or thumbnails, but let's pretend it is. I'm going to do you something slightly different. I'm going to tell you what to actually do calmly, with actual data, without anyone shouting at you, because the data is reassuring, considerably more reassuring than most of what you're currently seeing. Let's go. I'm Leo, welcome back to Financially Fit Millennial. Today, the market crash playbook when you feel like soil in your pants. What to do, what not to do, and why the scary moments you're currently in has happened many times before and ended the same way every time. Let's start with what we're actually dealing with. First things first, before we talk about what to do, I want to make sure we're all talking about the same thing, because the market is crashing gets used to describe everything from a mildly annoying Tuesday to an actual financial crisis. And those things require very different responses. There are 4 different things that get called a crash. First, a pullback, 5% or less. Happens all the time, barely worth mentioning. The market has had a bad week. This is the financial equivalent of a headache. Mildly annoying, will pass, not a crisis. Second, a correction, 10% or more from the recent peak. This sounds scarier. It happens roughly every year and a half on average. It is completely normal. It is, in fact, healthy. It releases built-up pressure in valuations and creates entry points for new investors. Still not a crisis. Third, a bear market, 20% or more from the peak. These are rarer, roughly every 3.5 years. They feel awful when you're in them. They last an average of about 9.5 months, and every single one in history has been followed by recovery. Fourth, a crash, 30% plus, fast, often triggered by a specific event. 2008, COVID in March 2020, the dot-com collapse. These are the ones that feel like the end of the world. They're not, but they require the most nerve to hold through. Knowing which one you're in matters, because the response is broadly the same, but the emotional difficulty scales up significantly as you move right along that dial, and the temptation to do something destructive scales up with it. Right, let me give you the single most important fact in the entire video, and I want you to actually sit with this, not just let it wash over you. The S&P 500 has experienced every major financial shock of the last 100 years. 2 world wars, the Great Depression, multiple oil crises, Black Monday in 1987, where the market dropped 22% in a single day, the dot-com bubble, the global financial crisis, a pandemic that shut the entire world economy down in 5 weeks. And the index is still here, still higher than it has ever been. The long-run chart looks, from a distance, like a line that mostly goes up with small, dramatic-looking dips that turn out to be tiny blips when you zoom out far enough. The 2008 crash, one of the worst financial crises in the century, saw the S&P 500 drop 57%. If you'd bought at the peak in October 2007 and just held on, you'd have had your money back by 2013. And from the 2009 low to today, the index is up over 700%. COVID, March 2020. Markets dropped 34% in 5 weeks, the fastest bear market in history. 5 months later, the S&P was at a new all-time high. Every single bear market in the recorded history of the US stock market has eventually recovered and gone on to new highs. That is not a guarantee of the future, nothing is, but it is a remarkably consistent track record. Right, so what do you actually do? Here are the 5 things, and I want to be clear that these are in order of importance. Number 1, do nothing. I know, sounds ridiculous, but doing nothing during a market crash is genuinely one of the hardest and most valuable things an investor can do. The urge to act, to sell, to move things around, to do something is completely natural and almost always wrong. Your investments don't know you're watching them. They don't care. The only thing that converts a temporary paper loss into a real permanent loss is clicking sell. Number 2, keep investing. The people who kept investing during COVID's March 2020 crash bought at the lowest prices in years. 5 months later, their portfolios were at new highs and they bought the dip they never even had to try and time. Number 3, check your emergency fund, not your portfolio. If you have a properly funded emergency fund sitting in cash, 3 to 6 months of expenses, separate from your investments, you're protected. You have no reason to sell investments to cover life surprises. This is why the emergency fund video comes before the investing video in every good financial education plan. If you don't have an emergency fund yet and your portfolio is down, that's a stressful place to be. And it's a very good reason to make the emergency fund the priority going forward. Because without it, market volatility isn't just psychologically uncomfortable, it's a genuine financial risk. Number 4, look at your risk profile. If the current market conditions are causing you anxiety, not mild discomfort, but actual stress, that's useful information. It means your portfolio may be more aggressive than your psychology can actually handle. And that's worth knowing and addressing calmly, not reactively. A considered, calm reallocation to something that better matches your risk tolerance, done when you're not panicking, is sensible. Panic selling everything at the bottom is not. The free risk profile quiz at financiallyfitmillennial.com takes 2 minutes. Link in the description. If this week has been uncomfortable, it's definitely worth a look. And number 5, get selectively greedy. Warren Buffett's most famous piece of advice: be fearful when others are greedy, be greedy when others are fearful. This is what he means. Quality companies, good businesses with real earnings, real products, and real long-term futures don't disappear during a market correction. Their prices go down. The underlying business hasn't changed. If you've been watching something good for a while and thinking, I'd love to own that, but not at this price, a correction might just hand you the entry point you were waiting for. Not reckless, not betting the house, but considered, research-backed additions to your portfolio of quality assets at discounted prices is what long-term wealth is built from. Right, now the flip side. 3 things that feel right during a crash but will cost you dearly if you do them. Never panic sell. This is the big one, and the data on how badly it goes is unambiguous. Over a 20-year period, if you stayed fully invested in the S&P 500, you'd have earned around 9.8% annually. If you'd missed just the 10 best days in the market, 10 days out of over 5,000, your return drops to around 5.6%. Miss 20 best days, 2.4%. Miss 30, basically flat. Here's the brutal part. The best days in the market almost always happen right in the middle of or immediately after the worst periods. The biggest single day gains in stock market history occurred during the 2008 financial crisis and the COVID crash, not during the calm periods. During the chaos. The person who sells during a crash and waits for things to feel safe before buying back in, they almost certainly miss the best days. And as that chart shows, missing just 10 of the best days over 20 years takes a 9.8% annual return and cuts it in almost half. That is the real cost of panic selling. Never try to time the bottom. I'll wait until the dust settles and then I'll buy back in. This sounds completely logical. Here's the problem. Nobody knows where the bottom is. Not the hedge funds, not the analysts, not the economist, not me, not you, not the bloke on YouTube with the alarming thumbnails. Markets don't ring a bell at the bottom to let you know it's time to get back in. They just start going up, often very fast, very suddenly, with no warning, while you're still waiting for things to feel safer. By the time it feels safe, you've missed the recovery. Vanguard's research is clear. Lump sum investing beats waiting in cash roughly 2/3 of the time over any 12-month window, because markets go up more often than they go down. Waiting is a strategy that sounds sensible and consistently underperforms. Never make permanent decisions based on temporary feelings. A market drop is temporary. Every single one has been. A panic sell is permanent. The loss is locked in and the recovery happens without you. These two things get confused all the time. The feeling that tells you to sell right now is the same feeling that will tell you 3 months from now, when the market has recovered, that you should have held on. Trust the long-term plan, not the short-term emotion. Let me zoom out for a second, literally, because I think perspective is the most useful thing I can offer you right now. What looks enormous and terrifying when you've zoomed into the last 3 weeks looks like an almost invisible blip when you zoom out to a 20-year chart. The anxiety of right now is real. The significance of right now in the context of a 20 or 30-year investment journey is much smaller than it feels. The S&P 500 closed above 7,600 for the first time ever on June 2nd this year. 4 days later, it was pulling back and the headlines were full of doom. In 5 years, both of those data points will be somewhere in the middle of a chart that ends considerably higher. That's not certain. That's not a certainty. Nothing is certain. But it is the weight of history. And the weight of history is overwhelmingly on the side of staying invested, staying calm, and letting time do the heavy lifting. Markets crash, corrections happen, bear markets feel awful. These things are not bugs in the system, they're features. They are the price of long-term returns that make investing worthwhile. The people who build wealth through stock market investing don't do it by being smarter than anyone else about timing. They do it by staying invested when everyone else is selling, keeping contributions when it feels pointless, and trusting a plan they built when they were calm rather than reacting to feelings they have when they're not. 5 things to do. Nothing, keep investing, check your emergency fund, review your risk profile, and look for quality at a discount. 3 things never to do: panic sell, try to time the bottom, or make permanent decisions based on temporary feelings. If this helped, send it to someone who's currently spiraling over their portfolio. It might be the most useful thing they see this week. Subscribe if you haven't, drop a comment below. What's your biggest fear during a market crash? All right, legends, see you in the next one.